If there's one question that quietly keeps most capable people on the sidelines, it's how much money do I actually need to get started investing in real estate? So don't listen to what social media says or what your friends say. Let's get the real answer here. So today we're going to break down and calmly and clearly discuss what you really need as far as financing is concerned and what it actually takes to buy your first rental property. Hi, I'm Greg Kurzner, and welcome back to the Real Estate Launchpad podcast. In our last episode, we talked about a clear path to buying your first investment property. So today, we're going to zoom in on that part that causes a lot of hesitation, and that's the money part. Because what I've seen in these last 30 or 35 years in real estate has been this. Most people, they don't lack opportunities, they lack clarity. And that clarity is a lot of times wrapped around capital. How much money do I need? I just don't feel like I have enough. And when money is undefined, investing seems very, very difficult. I've worked with people who've earned very large incomes and assumed that they need hundreds of thousands of dollars to begin. And I've worked with others who have actually had enough money to start, but they didn't realize it. See, money uncertainty creates two reactions. Some people delay this for years, waiting until they feel ready or they feel like they have enough. And others try to shortcut the process and they take risks that they shouldn't. Neither of these paths creates a calm investing environment. But having that clarity about money does. So let's break it down. And I'm going to go through this in a series of steps. So step one is your down payment. This is the one piece that most people kind of fixate on, the down payment. And yes, it's, that investment properties typically do require a down payment. And that down payment can be larger sometimes than a typical owner-occupant financing. But the down payment is just one piece of the total picture. So let me explain how investor financing works. Conventional investment loans, which are kind of like the Fannie Mae, Freddie Mac loans that you are used to getting for your owner occupants, they also offer investor financing. And these conventional investment loans require anywhere between 15 to 25% down. But that's not the only lane that investors can use. There are a lot of other financing paths that investors use all the time. And it just depends a lot of times on their situation. So let's talk about some common financing lanes. As I mentioned before, we have conventional investor loans. This is probably the most common route, especially for people getting started early. So let's talk about that. Why are those very common? Well, first of all, they do require a certain down payment between 15 to 25%, like I said, and they're usually 30-year fixed loans. That's the kind of standard mortgage structure that you're probably used to. For a lot of investors, this becomes a long-term foundation for building a portfolio. We also have another type of loan program that I'm sure you're familiar with called FHA loans. And these loans are primarily for what I would call 2 to 4 unit properties. So a 2 to 4 unit property is a duplex, triplex, quadruplex. FHA loans are typically lower in down payments, sometimes as low as 3 to 5%. But there's a catch, and the catch is this. You have to live in one of the units. So this is a really good investment type of loan for someone who wants to buy a duplex or a triplex or quadruplex and wants to live in one of the units and rent the others out. An example of this is called a house hacking strategy. Another type of loan is VA loans. For those that are eligible for VA financing, the options can even be more powerful. VA loans can be extremely low or even zero down payments in some cases. So they're similar to FHA in that they have low down payment requirements, and some investors can use these to buy multi-unit properties while living in one. So FHA and VA are really good vehicles to finance properties when you're house hacking, especially 2 to 4 unit properties. Now, we have another loan type that you may have heard of, maybe not, and it's become kind of in vogue at this point. It's called a DSCR, and that stands for debt service coverage ratio. So investors that are more experienced may want to try and use these types of loans, and they are more focused on the property's income potential than the borrower's personal income. They're commonly called investor scaling rent. You still do need to have relatively reasonable credit score, but they're not looking at your income and your debts as much as they are what the coverage ratio is between the rent income a property generates and the debt service that it requires. They're commonly used by investors who are looking to scale up their rental portfolios. Another type of financing that investors use a lot is called private money. Private money typically comes from individuals rather than banks. Some lending companies that are not, if you will, commercial banks also lend private money. And sometimes from a partner, it could be an experienced investor, or it could even be a capital company that is not a bank. But this is someone investing their capital passively. And these arrangements can vary widely, and they're very common in real estate investing. And finally, we come to hard money. So hard money loans are short-term loans, and they're used primarily for renovation projects. They often fund both the purchase and the renovation, and they come with higher interest rates and shorter timelines. They're typically used for fix and flippers and heavy value add projects. Now, one of the really neat ways to get into the real estate investing process when you don't have a lot of capital, or maybe you don't have ideal credit, is with seller financing. So sometimes the seller of the property is willing to take back a mortgage to sell the property, and then they'll get a stream of income from interest over the life of the loan. So instead of borrowing from a bank, you make your payments directly to the seller. And these situations, while less common, can be very powerful when they occur. The point here is not to memorize all the different loan products. It's simply to understand that investors have all kinds of options and multiple financing lanes when looking to purchase. So besides down payment, there are some other costs with getting financing that you should know about. Things like closing costs, insurance, maintenance reserves, tax prorations, and things like minor repairs. These things shouldn't be surprises. They're simply line items. Closing costs include your costs to get your loan, like lender's fees, appraisal fees, title work, attorney's fees, mailing, deeds, things like that, that kind of all add up at closing. And then setting up your insurance. Sometimes you have to pay for an appraisal outside of closing and an inspection. So you have some other costs related to the financing. So if you're watching me on YouTube, you probably have noticed that I have done a costume change. Totally out of my control, but had to break away halfway through this and had to pick this up the next day. Okay, so we talked about down payment. It is obviously a really big part, and it's what most investors focus on and kind of fixate on. And we also talked about closing costs, things like lender fees and insurance, appraisal, inspection, prorations for taxes and insurance, and even repair reserves. Now, let's get into the next thing that we need to kind of focus on, and that is after we purchase the property and after we have our tenant, then we need to have some reserves put away just for vacancy, to make repairs, and for any kind of abnormal, unpredictable things that might happen once we own our property. Reserves don't just protect the property, they protect your mental psychology, if you will, so that you don't have to worry about, oh my goodness, my air conditioning system broke, or there's a leak in the roof and I don't have the money to fix it. So a common misconception is that the first property that you buy should dramatically increase your income. You know what? It's rarely the case. And what I really want to point out is that your first transaction, while it should be a good deal and while it should hopefully make you some income, it is not the job of your first property to create your wealth for the rest of your life. It's to create that stability. It's to give you that experience that you need. And it's to build the momentum that you need to be an investor so that you can grow your portfolio and scale. So what people actually need to focus on is, how much money do I really need in reserves? Well, it depends on your market and it depends on your financing lane. So most investors generally start out with this clarity that they need money for a down payment, they need money for closing costs, and then they need money for reserves. So it's not an unlimited amount of capital. It's just preparation. What does that look like? My personal opinion and what many property managers suggest is that you have 6 months of payment expense that you can use for vacancy. So if you have no tenant for 6 months, that you will have reserves enough to pay the mortgage payment, have the lawn cut, have the utilities on, and just generally cover expenses for up to 6 months. Now that might seem like a lot, but it gives you that comfort. And it's better to have that money put away in reserve so that if you need to draw upon it, you can. So the big takeaway is that, well, the investing part, it seems kind of straightforward. The financing part can be vague and it can feel kind of risky. When it gets down to the money and the buckets that you use, whether it's VA, FHA, hard money, private money, even conventional financing, it really matters how you approach it and what the most important goal is for you with the property. So here's the big takeaway. When money is vague, investing feels risky. So when you have the money thing defined and you know which bucket you're going to be getting the money out of, then your investing becomes strategic. So if you're unsure where you stand financially or what might be holding you back, take the short quiz that I've linked below. It'll help you identify exactly where you are in the investing path and what your next step should be. In our next episode, we'll talk about something that's equally important: how you evaluate whether a rental property is actually a good deal. I'll give you some really easy and straightforward ways to take a look and know very quickly whether this is a deal that you're interested in or one that you need to pass on. So thanks for listening, and I'll see you next time.